They make money on what's called EBITDA arbitrage. So buying you at one multiple, rolling you into a larger platform, and then selling the entire group at a higher multiple. This is how they make money, whether you're a new platform or you're an add-on. Now I'm going to double click on this because it's really, really important to understand how they make money and why they buy essential services with this strategy. So if you are a $20 million EBITDA landscaping business, let's say it's $100 million top line, a $20 million EBITDA landscaping business in, let's say, Texas, that business is worth, on a bad day, probably somewhere in the neighborhood of 10 to 15 times. So let's just use 15 times as an example. So that business is worth, on the open market, $300 million. Now, if it's a $20 million EBITDA landscaping business, more than likely it's owned by a lower middle market private equity firm. We would imagine that they typically have between $500 million to $4 to $5 billion of assets under management. That's a lower middle market private equity firm. Sounds like a lot of money, but there's much, much bigger private equity firms that have 30, 40, $50 billion of assets under management. Lower middle market private equity firm typically has $500 million to $4 to $5 billion of assets under management.